Okay, so dear professors, we have interpretation of accounts or accounting ratios. And as we established from the onset of accounting, the essence is to get meaningful information to interested users, right? So a financial accountant is, interested in making the data organized, more meaningful, right? For users to be able to take decisions. And this is one of the ways the financial accountant can make the accounting data more meaningful. So let's see these accounting ratios. I'll skip the introduction and go to the learning objective. So by the end of this class, we should be able to identify the tools for interpretation of account, state the reasons for the use of accounting ratios, state the limitations of accounting ratios. Also, let's explain the types of accounting ratios, and finally, to be able to state the formula and calculate various accounting ratios. Okay, so without wasting time, let's pick the first, which is definition of accounting ratios. Definition of accounting ratio. Okay, as mathematicians, I want to believe you remember ratios to be, establishing relationship between two variables, right? In mathematics, you see them. Maybe x is to y or 3 is to 2. Okay. So the essence is that they want to establish a relationship between two variables or items. So it's the same idea when it comes to financial accounting. We want to establish relationship between two variables. But what are these variables? These variables are items on the face of the financial statement. And when I say financial statement, professors, I'm referring to the trading account, the profit and loss account, and the balance sheet. So all the items on this financial statement, we can establish relationships among them or between them. Okay. So for instance, we can have a relationship between the gross profit and our net sales revenue. We can have a relationship between our capital employed and the net profit. We can have a relationship between our total fixed assets and, let's say, sales, right? So this is the picture I want to put in your mind. Please, if you have anything to say, you can go ahead. Prof. Pepper, you wanted to say something? Okay. So I'm going to need one of you to read for me the definition of accounting ratios as I've highlighted. Okay. So who's going to do that quickly? Prof. Jacinda, I think you do the reading for me this time. Okay.
Definition of accounting ratios. They are a group of metrics used to establish the relationship between items of the financial statements of a business with the purpose of measuring the efficiency and profitability of the business. Accounting ratios provide means of evaluating a business performance through comparing items on the trading profit and loss account and the balance sheet.
Okay, great. That was awesome. Thank you, Professor. Okay, so as she read, accounting ratios are normally metrics used to establish relationship. So the key point here is that the essence of the accounting ratio is to establish relationship between items of the financial statement. Why do we want to do that? Because we want to measure the efficiency and profitability of the business. We want to look if the business is performing in terms of its sales, if the business is performing in terms of reducing costs. Okay, so that's the essence of accounting ratio. Now, it goes on to say a ratio is typically defined as a mathematical statement that represents the relationship between two distinct objects. Similarly, accounting ratios are those that are computed using financial data documented in a company's financial statement, right? Okay. Now, why are we even looking at these ratios in the first place? So that will put us to the uses of accounting ratios. And the first one is accounting ratios are used to show trends in cost, sales, and profit. And I want to believe my professors understand this point. Okay. The essence of computing the ratios is because we want to know the trend in cost, right? And when we say trend, we want to look at series of, cost measurement and see whether there is a continuous increase or decrease, or there is fluctuating increment and decrease, right? In cost, sales, or maybe profit. So for instance, we can have, say, ratios for the past 7 years, and we'll be able to determine whether cost is increasing every year or decreasing every year. We want to see the trend, right, in the cost or sales and profit. So that's one of the first uses. The second is they are used to analyze operational efficiency of the business. Okay, some of the ratios seek to check if the business is being efficient in its operation. A typical example is one of the ratios that establish a relationship between sales and gross profit. So the essence of this ratio is to be able to tell the users that the business is able to sell more, and for that matter, the sales adds to the gross profit. Okay. The three is that, or the third, they are used to undertake intercompany and intra-company performance comparison. Key terms here: intercompany and intra-company. Will any of my professors tell me what inter-comparison and intra-comparison means? Intercompany comparison and then intra-company. Any idea, professors? But I don't want to be calling, but at a point I have no option. So, Prof, yeah, you just joined. Okay, Prof, in cancer is up. Prof, tell us about intercompany and intra-company comparison.
I'll start with inter. So inter is the process of comparing the performance of multiple companies to identify the areas for improvement. So this is like comparing different other companies with your company.
Okay.
Comparing different companies together, multiple companies, to be able to identify areas for improvement. That's intercompany.
Okay.
And intra-company comparison is like a financial performance evaluation tool that helps businesses to understand their growth and performance over time. So that's kind of like an inside thing. But intra is like comparing other companies to your company. But intra is like comparing it's like a performance evaluation tool which will help you business to understand their growth and performances over time. Yeah.
Exactly. Okay. So let me give an example to settle the score. So intercompany, for example, is comparing MTN Ghana with Telecel, right? So these are two different companies in the same industry, right? You can't compare companies in different industries. It doesn't make a lot of sense unless you are looking at specific parameters that are common to these companies, right? So there should always be that basis of commonness, right? So they should be similar or they should be in the same industry, right? So comparing MTN to Telecel, right? Or even for you, you can do inter-colleague comparison where you compare your results to your colleagues' results. But if it is the intra means within the company, like Ella suggested. So when MTN, for instance, compares the profit it made 2024 to the profit it made 2023, then this is a self comparison or evaluation of performance over several periods of time, right? So like the example I gave, that it will be you comparing your first semester results to your second semester results. That is intra. So within the company itself, right? Maybe comparing 2023 performance to 2024, etc. Okay, so I hope that is settled. Great. If you have a question, please feel free to ask me and I'll address it. Okay, we also have that they are used to enhance cost control. Yes, I think this makes sense. As you complete the ratios, you can be able to tell where cost can be controlled. Accounting ratios are also used for forecasting events in the future. So they are also used to make predictions. For example, I think you can make predictions now into the future if you have certain metrics, to help you do that. So for example, if this year you have made 20% of your sales as profit, then the following year you can predict and say maybe I will do 25%, right? So these are some of the usefulness and okay, advantages of accounting ratios. Well, the first one, it is in better understanding of financial data. That is very true. It is also useful for comparing companies' performance against that of its competitors, right? So some of these theories, I think I will leave it out to you to deal with them. But if you have issues, come to me. I will explain further. The disadvantages are also there for you. Now to the major discuss, to the highly examinable areas, the types of ratios. So dear professors, we have 5 types of ratios. Or let me say for your level, we are going to consider 5 types of ratios. It's examinable. You can be asked to state 3 types of ratios for 3 marks. So note that. The first one is profitability ratios. Second, liquidity. Third, activity. Fourth is leverage, or sometimes referred to as capital gearing. Capital gearing. Okay, Prof. Nkansa, go ahead.
Please I want to take screenshots of the previous slides.
Oh, don't worry, dear. I'll share the full notes with you on the page. Okay.
Please, will you share it today?
Definitely, I will.
Okay, thank you.
You're welcome. I think I have Prof. Nanesi's microphone unmuted. So if you want to say something, please, Prof. go. Okay. So the fourth is leverage ratios or capital gearing, and the last one is investment ratio. Dear professors, for examination's sake, the first 3 ratios should be your major headache: profitability, liquidity, and activity ratios. These are the ratios that are highly examinable for WASSCE, right? So let's pick the profitability ratios. Well, let me prick the minds of my professors. So profitability ratio. We have just established that a ratio is a metric, okay? It's a metric or a mathematical symbol, okay, that establishes a relationship between 2 variables. So profitability ratio, do you have any clue what it does? Prof. Amma, I think you haven't spoken today. Can you share with us your view on this?
Service, I think I'm trying.
Oh, try. Feel free. Okay, feel free.
So maybe the profitability ratio will be maybe measuring the probability profitability of a business.
Okay. I think you haven't taken your tea. That's why the English is not.
Yes,
Okay.
I haven't.
Thank you very much. That's awesome. Prof. AC, go ahead.
So please, I think for the profitability, you see, for the ratio, the business, sometimes they compare with their competitors.
Sure.
So they compare their profits to other companies and to see if they are making like immense.
Okay, that's great. Thank you very much, Prof. AC. Any other from any of my professors, Prof. Nana, Echia, Prof. Ya, Prof. Jacinda, Prof. Pepra, and Prof. Senam. Prof. Senam, can I hear you on this one? We are all trying, okay? So there's no harm in trying. Okay, so let me pick it up. So, okay, Prof. Senam, go ahead.
Please, I think what they said is correct.
Okay, that's awesome. No big deal. What they said is perfectly true. Thank you, Prof. Senam, for that smart response, I should say. So, profitability ratio, you see, remember or note this, that the essence of calculating the ratio is to measure efficiency. Is the business efficient, right? As in, is the business doing the right things? So when it comes to profitability, you want to check if the business is efficient in generating profit or income, right? So the essence of these ratios is to measure the efficiency of the business in its profit generating operations, okay? Or to measure the efficiency of the business in generating profit in its operations. So it assesses how a business is able to use its fixed asset and capital to generate profit or revenue. So I think that settles the issue there. Now, there are several ratios that could be calculated under the profitability ratios, but for my dear professors, I think we'll pay attention to four of them, right? So let's pick the first one. The first ratio under the profitability ratio is the gross profit margin or percentage. Gross profit margin or percentage. So this ratio, okay, measures the efficiency of the business in its trading operations. The trading here should give you the clue or the link with gross profit, because you remember gross profit is determined in the trading account, or it is the profit you make from buying and selling. Okay, that profit you make from buying and selling goods or merchandise is called gross profit. So it only makes sense to say that gross profit percentage as a ratio measures how the business is efficient in its trading operations. Okay. So this ratio is only measuring how the business is performing when it comes to buying and selling of goods. What is the formula for calculating this ratio? Very simple. So it is your gross profit, okay, divided by your net sales. Your gross profit divided by your net sales, you multiply by 100%. That'll give you the ratio. So dear professors, you need to remember this formula because you will need it definitely when this topic appears in any of your exams, right? Okay, the second one is net profit margin or percentage. Okay, now the net profit percentage ratio is looking at, again, how efficient the business is in generating profit, this time not only from the trading activities, but from all of its operations. So it goes on to say that it looks at the main trading operations together with other activities that generate profit for the business. And as well, we can link this to the profit and loss account, right, where we determine the net profit. In the profit and loss account, it is your gross profit, that is the profit you made from your trading activities. Then you add other income you are getting from other activities. Right, so the net profit is looking at all your operations, i.e. your trading operations and other operations that are generating income for the business. Again, the formula for this is net profit divided by net sales times 100. Very simple, isn't it? Okay. The next ratio is what we call return on capital employed. Return on capital employed. Last I asked the student, what is capital employed? And he told me it is the capital you employ in a business. As simple as that. So we know that capital employed refers to the quantum of resources that has been invested in the business. Okay. So if we look at return on capital employed, we want to see how the resources we have invested in the business is yielding returns or profit. Okay. So this ratio assesses the ability of the business to effectively use resources invested by the owner to generate more profit. Right? So it is establishing a relationship between our profit and then the capital invested by the owner. So the formula is your net profit divided by capital employed times 100%. Dear professors, I would want somebody to tell us how to calculate capital employed from the balance sheet. That's the clue I can give you. Capital employed. How do we calculate it? I'm forced to call somebody, but I would want somebody to voluntarily. Capital employed. That's the total resources invested in the business. How do we calculate that? Let me call Jacinda on this one. Jacinda, I'm sorry, but I have to call you. Prof. Jacinda. I think it's all ladies here, right?
Please, I'm still figuring how to deal with them. I'll let you know.
Okay. I'll wait for you then. Prof. Ella, can you break this one for me? Capital employed.
Yes, sir. I'm trying.
Okay, sure, try.
I think it's the finance by that part.
Okay, that is true. Under the finance by section. So under the finance by section, I think what you do is you bring in your opening capital, you add on your profit. If it's a loss, you deduct, you less drawings, and then you add long-term liabilities. Well, if that side is a bit complicated, you can assess your capital employed by looking at your total assets. And when I say total assets, I'm referring to your fixed asset and current assets all together. So your total assets minus your current liabilities. Okay, that is easier to get your capital employed. But like you said, it's your closing capital plus your long-term liabilities under the finance by. Right. Dear professors, I think I'll spare some few time, not in our normal class, to really go on to this balance sheet preparation and then the adjustment to the trading profit and loss account. Okay, it's a promise. And I beg you, hold me to this promise. Okay. Thank you. So your capital employed is your total asset minus your current liabilities. Okay. So note that down because you need it in your computations. The last one is return on shareholders fund. Actually, the third and fourth ratios are the same, but this is for a sole proprietor. Okay, the return on capital employed is for a sole proprietor, and the return on shareholders fund is for companies, right? For companies. So it also seeks to look at how the business is doing in terms of using how much shareholders have invested or the resources provided by the shareholders to generate profit, right? So the formula is net profit divided by shareholders fund. And what is shareholders fund? Is your stated capital plus your surpluses and reserves. You would appreciate this when we get to company account, right? So for now, you can just take it as a bonus point. Okay. Now, there's a general rule you need to also appreciate, that the higher the profitability ratio, the better for the business in terms of its performance. So if you compute a ratio, which is a profitability ratio, and then the percentage is higher, then it means the business is performing. So for example, 20% return on capital employed versus 30% return on capital employed would say that 30% is better. So the higher the ratio, the better. So these are your profitability ratios, right? Quickly, I would want my professors to tell me the ratios we just discussed and probably tell me the formula. So you tell me a ratio and then you give me the formula. This one I'm going to call Prophet Chang. I'm coming to you on this one. Just give me one of the profitability ratios and state the formula. Or I've hidden the formula, so I should go up for you. Prophet Chang, your mic is muted, so if you can unmute. Okay, I think Prof is enjoying some banku, so let me go to Prof AC. Okay, I'm struggling to hear Prof AC, but her mic is on me. Okay, Prof Jacinda, I think you hold on a bit. I have Prof AC, go ahead.
Return on capital employed.
Okay, the formula is
Net profit over capital employed multiplied by 100.
Thank you very much. Prof Jacinda, quickly bring in your ratio and the formula. Okay, Prophet Chan is back. Jacinda, let me pick
Okay,
Prophet
please,
Chan.
Okay.
So Prophet Chan, go
Please,
ahead.
profitability ratio.
Okay,
Profitability ratio.
okay.
The gross profit out of net sales times 100.
Okay, so that's the gross profit margin. Thank you very much. Okay, so dear professors would have to resume on the second session. So the details are there on the page. You join that with the second session. This session is up. So I'll see you in the second session. We'll continue from the liquidity ratios. Thank you very much. See you there. Bye for now.